Does anything matter for financial markets other than the U.S. presidential election? That's the question we're going to ask ourselves here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And needless to say, the week has a screaming tentpole of event risk that faces us here as we prepare to finally, hopefully, get the outcome on the U.S. presidential election that everyone has been waiting to resolve. What we're going to do here is quickly get to that discussion, but first knock off some of the other big macro developments on the calendar for this week, because it is not a light one, and start that conversation with a look at how markets performed last week. The story should be a familiar one at this point. Stocks down yet again. This time the Nasdaq joining the S&P 500 on the downside. S&P down 1.5%, Nasdaq down a little bit more, 1.7%. And again, that weakness against the backdrop of higher yields. Rates rise a little bit more at the long end than they do at the short end, so the curve steepens a bit. We are now back to some of the steepest readings on the yield curve that we've seen all year, and that's not surprisingly giving a bit of indigestion to stock markets once again. The story then kind of unravels. The U.S. dollar puts in a mixed performance. It was down against the euro, but up against most other currencies. Gold takes a little bit of a step back, but only just a slight retreat, down 0.2%, and that's after hitting record highs. Crude oil comes down a bit, 3.2%, after Israel retaliates against Iran and only hits military targets. But of course, the rhetoric has since ratcheted up again, and so there may be more to this yet. Crude oil has already erased most of those losses. So a hodgepodge of outcomes outside of the core stock and bond markets, where the story last week continued to be hotter U.S. economic data with a cutting central bank is reflation. Reflation is higher rates downwind, less scope for the Fed to cut, especially next year. And that, as a catalyst for stock markets, clearly ending up as a headwind. With that in mind, we enter this week with a pair of monetary policy announcements outside of the U.S., and we'll go through them quickly here to get a sense of what might happen. Obviously, the U.S. Election will have a tremendous gravitational pull on most things, but as we say, it is not the only thing. First, ahead of the election, we are going to get the RBA monetary policy announcement. No changes expected here. As we can see, for 2024, the markets are pricing in no change in rates at this stage, just a meager 4 basis points in cuts on the menu. So that's no change this time and none again in December. For next year, the outlook has significantly shifted in a more hawkish direction. That's despite some of the disappointing economic data we've seen out of Australia, in particular, 2 consecutive months now of shrinking economic activity, looking at the PMIs, and disappointing CPI numbers that came out just last week, which of course makes for an interesting disconnect here, because clearly the direction of travel has been toward less dovish policy, 50 basis points in cuts on the menu for 2025. So here's how this curve looks, and we can see the steady shift to this less dovish, as it were, setting. Not quite hawkish. We still are looking for cuts, but far fewer of them than we did when the RBA last met in late September. A little bit closer to August, but of course more hawkish than that as well. If the RBA decides to name check some of the recent economic weakness, and especially the CPI numbers, we could see a bit of a rethink on the trajectory. certainly not a significant possibility that the RBA actually cuts this go around, but they could signal that they're readier to do so, and that maybe the scope for next year is a little bit more robust. That would give us a reaction lower, most likely, in the Aussie dollar. We can see it's digesting above 65.40 here, and the 66 figure seems to be acting as potent resistance. 66.23 just above that, the former swing low acting now as a topside barrier. If this digestion proves to be enough of a consolidation to reset after a long decline, and then we get a more dovish view on the RBA, we could end up at the lows here, and then of course we'll see if we can make hay through the 65 figure, because that would really expose significant downside into the mid 63s. Then after the election, a policy announcement from the Bank of England. Here we're looking at 31 basis points in easing being baked in through the rest of the year, so that's at least one cut, and 62 basis points for next year, so that's at least two cuts. Looking at the way that they are going to break down in time, benchmark SONIA futures here, we can see have the November cut almost all the way baked in here, 77 basis points above 4 here, so that's only 2 basis points away from 475, which would be fully baking in the cut. So that looks like an almost done deal. A little bit of a possibility for further easing in December, consistent with this being 31 and not just 25, so a little bit more than one cut on the menu. And here again you're looking at economic data that's increasingly disappointed recently, and so perhaps this more hawkish shift recently, you can see it here in the drift up for the current curve relative to where we were when the Bank of England met in September and in August. Here you can see the same sort of adjustment here, so we can see most of it happens for 2025, whereas the outlook for this year holds relatively steady now for several months. And so we end up then with the possibility that this too could get a bit of a dovish adjustment. RBA holds steady, that's priced in. BOE cuts, that's priced in. In both cases, the impetus might come from the guidance, not the decisions, and in both cases it could be biased somewhat dovish. For the case of the pound, we've already drifted through support at around 130, and now we're hovering in this area about 128.94, 128.33. This is a inflection zone here going all the way back to the beginning of the year. If we can get through that on this week's price action, then we open the way down into the low 126s and set the stage for the next leg in this decline. Now shifting gears over to the US, where of course the bulk of this week's action rests. And we'll work our way backwards to the election and start with US economic data and the Fed monetary policy announcement that's going to get informed thereby. So, as far as the big economic data releases, the thing to keep an eye on this week is going to be the ISM services report. This is, of course, a PMI survey from the Institute of Supply Management that captures the biggest piece of the U.S. economy, the service sector, and where inflation most resides at this point. The expectation is we're going to get a slight step lower, down to 53.8 after this surge in service sector activity in September. That was the strongest reading in 19 months. So a bit of a step back is certainly a reasonable kind of expectation. A bit of a cooling. We can see here that we already got the manufacturing side of the two surveys here for October, and that came in a little bit lighter than expected. Manufacturing, of course, was already expected to contract. Under 50 is contraction on these numbers. Above 50 is expansion. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. So here, the expectation on manufacturing was 47.6. We got 46.5. So we got the contraction, but it happened at a slightly faster rate in reality than forecasts had it. That doesn't much change the overall structure of what's going on here, where the robust service sector has been offsetting the anemic conditions on the manufacturing side. And as long as we register broadly in line with expectations, this should not alter much of the underlying economic calculus. However, of course, it is important to remember that at this stage, U.S. economic data is increasingly beating relative to expectations, according to this data from Citigroup. And what that means is that we might get an upside surprise here. Once again, that would speak to a reflationary narrative and imply more of this. More upward pressure on rates, more downward pressure on stocks, assuming they continue to respond to what's going on in rates as they have been over recent weeks. But of course, this data comes ahead of the election and ahead of the Fed policy announcement. How much follow through there is to expect on this kind of data, unless there is a wild deviation from forecasts before those bigger event risks come into the picture, that seems suspect. Now, for the Fed rate decision itself, we have what appears to be at this point a done deal. Markets have priced in a 98% probability that the Fed is going to cut by 25 basis points. As it happens, if we look down curve, we can see that we're biased overwhelmingly in favor of a pair of rate cuts, both at this meeting and at the meeting in December. We can see here we're on track for both of those cuts at this point. And then when we look at the menu for next year, we're coming up on just about 73 basis points in easing. Looking at this in tandem, we can see with that improvement in U.S. economic data that we just saw, that's this right here, we have also seen a significant shift in Fed policy expectations. First off, we can see here was where the Fed actually started its cutting cycle in September. And of course, we can see the curve has shifted significantly to a more hawkish setting. Now, rates going into a year from now are seen much higher than they were down here. You can see the difference at the tail end by September is almost 3 full cuts. We were at about 3 here in September and about 373 now. That shows up in this calculus here, where we can see over the course of the next 2 meetings and all of next year's meetings, we're looking for just 4 cuts in total, about 106 basis points in cumulative easing. That's already less dovish than the Fed's own forecasts back in September. The Fed said 100 basis points in cuts this year. 50 of those are already in. 50 more over the next 2 meetings look like autopilot. Next year, 100 basis points again. And the markets are now flirting with the idea that we'll maybe get 3. The cumulative market pricing for next year at this stage showing us that the markets are positioned for just 73, 74 basis points for next year. So what we're going to be looking for from the Fed is some kind of commentary acknowledging that economic data since they last talked about this has meaningfully changed, that the conversation now is about a stronger economy, and see if that gives us a sense that anything about their intent for next year is already shifting. And if we get that sense, and if that sense is again toward higher rates, that could be once again a boon for the dollar, as it's been over recent weeks, and spell trouble for stock market. Now finally on to the election. The polls suggest we are at a dead heat. They've normalized to essentially 50-50. As we can see here, this is the aggregate from Real Clear Politics of national polling data, and we are locked up right at the same level here. There is virtually no spread between the polling averages for these candidates. As we look at what's happened for financial markets over the course of this, it seems like looking at betting markets is an inevitable spot to turn, because so much of what has shown up, at least in market conversation around what this election might mean, has focused on the fact that betting markets have been a lot more volatile. Now, those betting markets are not necessarily representative. When we look at something like predicted, obviously we can see that the polls have been a sort of homing beacon, whereas a week ago there was a meaningful 60-40 split in favor of Donald Trump in the predicted market odds. That advantage has vanished, and we are now in a dead heat here, as we are in national polls. Something similar has happened for Polymarket, although the important caveat here is Polymarket is an offshore venue, which means that, at least theoretically speaking, Americans aren't trading on it. There are no actual voters, again, at least theoretically, in this sample. And so take that for what it's worth. But here, again, a very strong advantage for the Republican candidate, a massive narrowing of the odds. Then at the beginning of October, another splintering, and now a narrowing again. So everything that we're looking at here, no matter how much stock you want to put in betting markets, illiquid though they are relative to the kind of market signals we might take from global equities or currencies or bonds. These are much thinner markets by comparison, even to crypto, or at least the headline cryptocurrencies like BTC or ETH. So with that in mind, it wouldn't take a very big outlay to move these markets, again, in relative terms, which is why we keep reading about whales throwing on big bets and pushing these markets around. So take with a grain of salt what these show, whether they're offshore as Polymarket is, or onshore as predicted is, or Kalshi, which unfortunately we don't have an image for here. But as we look at all of these things, we can see that they're narrowing in on a coin toss as the baseline expectation, which is, of course, where the polls nationally have been for a while. With that in mind, it seems sensible not to look at this as something to be analyzed through the prism of likely policies, because nobody knows how much of either platform is viably going to get passed at this point. Those discussions probably had a role in swaying some narrow wedge of undecided voters one way or another, but that conversation is all but over. The election's tomorrow. So anybody who is still undecided is probably so out there in terms of the narrow numbers of folks that policy differences probably don't decide that calculus very much at this point. And so policies at this point become a conversation to have after the outcome, after the dust has settled. As for the outcome itself, that probably is better treated as the same kind of binary event risk that a piece of economic data might be, that an interest rate decision might be, in the narrowest possible sense. And looking at just the event risk, it seems likely that the deciding factor might be the degree of uncertainty after the polls close and how long that uncertainty persists. Because if there is one thing that markets don't like, it is uncertainty. Now, in looking at the narrowing of the odds, we are perhaps in a place for the markets where the probability of a Harris win has increased relative to where it was, let's say, a week ago or 2 weeks ago. And with that in mind, we are forced to reckon with what might happen were there to be a contested outcome or an unclear outcome, either because the election is very close or because Vice President Harris wins, and then history would suggest that former President Donald Trump would contest it. We make this logical leap because he contested the last time that something similar occurred in 2020, of course. So to the extent that this prolongs uncertainty, never mind policy or who actually wins ultimately or how that all finally breaks down over the coming days and weeks, the longer that the outcome is uncertain, the more of a headwind it is likely to be for stock markets because they don't like uncertainty. And perhaps the more of a headwind it is likely to be for bond markets, as a degree of sovereign risk premium is introduced into yields and they push higher, which might come down, the longer that uncertainty persists, to a stronger dollar, higher yields, weaker stocks, and perhaps also weaker gold, because higher yields and a stronger dollar might finally start to act as the kryptonite for precious metals that they usually are, despite the dislocation over the past week or two. And that is Macro Money for today. As ever, we are here Monday through Thursday right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what may follow. I'm on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for the Price of Truth Wednesdays, back with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow.